Yeah, hello. Uh, Good afternoon, and welcome back to my session. So it was like yesterday we were doing the chapter number 5, the pre and post incorporation profits or losses. So that is where we have started right from the session 1. So today is the session 3, and we are like going to complete this particular chapter today. Okay, so it's one of the most easiest chapters, like I was telling you, because module 2 entirely deals from chapter number 4 to chapter number 8. And basically, it constitutes about 30 to 35 percentage of the total marks. So now, when we talk about the entire company account, so from the name, it seems like to be a little difficult, or like say a little hard, or something like that. But actually, it is very easy. So when you go chapter by chapter and you start attacking, and then start with solving the illustrations that is actually being given in your textbook. And again, you also solve the questions that is given behind your textbook, and then you go to your scanners or you just have a look at your past question papers. So you feel that every particular chapter, once after the basics have been taught, is pretty easy actually. So you will be able to gain the confidence, and which is what I expect to like give it to you at the end of the session. And hope all of you are in par with whatever I'm teaching till now, the session 1. So, giving you a fast recap of the 2 sessions, so we are discussing about profits and losses prior to the incorporation date. So, when we say the incorporation date or the incorporation, the term incorporation is associated with the word company. So, this is company, here the company is being involved. And how it is being involved? Is it a first time company? No. Generally, there is a takeover of the existing business. So the business already exists in a different or another form of whatever it is, the other business form. And now what you want to do in order to increase your capital, in order to increase your capital and increase or the scale of your operations, you want to register it under the Companies Act. So company is governed under the Companies Act. So now when you're taking it over, it so happens that you can't suspend the business till the time your company is incorporated. And there is some time that is being taken for the company to get incorporated, and then only you can start doing the business under the company's name. So what do we do under this period, or what do we have to follow? What are the accounting treatments of the business that is being done during these 2 periods, or this in-between period? That is where the relevance of this topic comes to you. So tomorrow, if you're going to face such a practical situation, this is how you will have to get. So your set of accounting principles or your accounting methods have already advocated that the period from the date of taking over your business till the date of receiving the certificate of incorporation, that particular period should be treated as it is called as pre-incorporation, before the incorporation period. And once after the incorporation date, the company comes into existence, and it is only from then the company actually operates. You do all the operations in the name of the company itself. So it's pretty clear of what happens post incorporation. So our issue is to deal with what happens pre-incorporation. So that is the entire chapter about. So as I was telling you, when the questions that come from this kind of a chapter, you have to always present it in the form of a main presentation followed by the working notes. So generally, when you start reading the question, you will first be doing the working notes, which is behind, and you leave space for the main answer on the first page. All the working notes have to be related to your answer. That is how it makes sense. After finishing your working notes, you are supposed to do the statement. The final presentation, in case of a pre-post incorporation problem, is in the form of a statement. It is not an account. So when you say it is in the form of a statement, the heading for the statement becomes very important. As well as the heading, the conclusion also becomes equally important. Good. So what should be the heading? The heading should be a statement showing appropriation or allocation of the pre and post incorporation profits or losses for the year ended. That becomes very, very essential and important. What do you mean by for the year ended? That means all the P&L balances and all the profits or losses at the end of the year have to get transferred to the balance sheet. You cannot have anything balance remaining in those particular accounts. So that is the meaning. Clear? So what are the working notes that you'll have to do? One is the time ratio. The second one is the sales ratio. And then there is another peculiar adjustment, that is interest, calculation of the interest that is being paid to the vendor. So generally, when you take over another business, you're supposed to give them some money called as the purchase consideration and then take their business. But in this case, you will wait until the company is incorporated and then you will make a payment to them. So that is why for that particular time period, you are supposed to pay interest on the purchase consideration. So good. So when you are supposed to pay the interest on purchase consideration, there is a separate working note, either working note number 3 or 4 that you will have to do. So in that, what you will be doing, you will ascertain what is the date of taking over of the business and what is the actual date of payment of the interest or the purchase consideration to the vendor. That will be total number of months. In the total number of months, how much is pre-incorporation, how much is post-incorporation is what you have to ascertain. And then allocate that particular interest in that particular ratio. So this interest to the vendor is a peculiar adjustment which requires one working note. And then you go back to your main presentation. The statement will be having 5 columns. The first column is the particulars that you need to write, technically mentioning what are the heads of the expenses of the income. The second will be the total amount. As I told you, the P&L or the extract of the P&L or whatever statement is given to you in the question will have total amounts, either the total of the sales or the total of the cost of goods sold, total of the gross profit. From there the question starts. It is your duty, or the sum itself asks you to divide or allocate the total thing into pre-incorporation and post-incorporation. That is what you do in the statement format. So the second column is the total amount. The third column is the ratio. Ratio is nothing but the basis of allocation. And then you have pre-incorporation period items or the amount and the post-incorporation. Out of the 3-4 problems we saw yesterday, we solved 2 problems, and 2 problems was orally explained in the class, for which the notes I have actually prepared. So I'll be sharing it either in today's or tomorrow's session. Okay, so you can have a look at the particular solution. But as far as I have already explained to you, and I think there should be a good grip over whatever is the concept that is being taught to you. So today's session will go as follows. Since already you are thorough with it, there are major questions, like there are exam questions that have been asked from your illustrations only. So we have finished up till illustration 3. I will be working out the illustration number 4. Okay, and illustration 5 and 6 also. Actually, you have 6 illustrations. We finished 3. We are yet to do 3. Okay, so I'll be going on and doing the 4, 5, 6. 4 completely we will solve. Okay, 5 and 6 I will just explain and solve the working notes. I will want you to work out the final answers, for which I can give you the handwritten notes also, or it is the same like whatever is given in your textbook. So the choice is yours. Okay, so after we finish this, so I'm estimating around 1 hour we will take to finish these 3 problems, and after that we will be going to the next chapter, which is accounting for the bonus and the rights issue. Is that clear? So all of you, whoever is watching the particular video, I would request you to open up with the illustration number 4, page number 5.12. The downloadable link is already given to you. So go to that particular material, 5.12, chapter number 5, 5.12. So yes, I hope everybody is back. So good afternoon, everybody. So yeah, we continue with the illustration number 4. So everybody with me? Good. The partners of my 3 agencies decided to convert the partnership into a private limited company called MA Private Limited with effect from 1st January 2012. The consideration was agreed at crore and 17 lakhs based on the firm's balance sheet as at 31st December prior year. However, due to some procedural difficulties, the company could be incorporated only on 1st April 20. Meanwhile, the business was continued on behalf of the company, and the consideration was settled on that day with interest at the rate of 12% per annum. Here, so here we have got, again, there are 2 adjustments. So when we have started, I told you, whenever you start a question of this kind, it is first the working notes that you will have to do. So you start doing the working notes. So shall we start doing with the working notes? So we are going with the illustration number 4. Clear? And in the illustration number 4, we are going to do the first working note. As we are reading the question, I would request all of you also, if you are doing it, please start doing it along with me. First, we have to calculate the time ratio. For calculating the time ratio, as I have explained it earlier also, you require 3 dates. The first date is the date of taking over of the business. The takeover of the business in your illustration number 4 has happened on 1st of January. Okay, and then the second date is the date of incorporation. Incorporation date becomes very, very important and critical. So when you read the question, you understand due to some procedural difficulties, the company could be incorporated only on 1st of April. So this is 1st of April. Clear? And then what is the third date that you need? You need for the closure of the, correct? So for the closure of the books, it is better that you go down and you are going to see above it. So just skip it and then go. The same books of accounts were continued by the company which closed its account for the first time on the 31st March the next year. Correct? So it is 31st March the next year. So now this period, the difference between date 1 and 2 will be pre-incorporation. The difference between date 2 and date 3 will be the post-incorporation. Is this clear? So then we come to what is the pre-incorporation period. Is to post-incorporation period. So when you write like this, from 1st January to 1st April that year, and from 1st April to 31st March the next year. Correct? So from Jan to April it is January, February, March. So since April 1st, you're not supposed to include April, and there's only 3 months that you will be including. So this is 3 months here, and from 1st April to 31st March the next year will be 12 months. Is this clear to you? So you can ask me, Madam, in all the illustrations and examples that we've seen till now, we have only seen the 12 months getting allocated as 4:8 or 5:7. That is what we have seen. But this is a peculiar case wherein it goes beyond your 12 months also. So can we have a sum like that? Obviously, you can have a sum. So generally, this is a practical situation wherein it takes so much of time for you to get registered as a company. So there is no harm. Whatever is given in the question, if you're going to write it correctly and then assimilate it correctly, your answer will be correct. Okay. So if you have any doubts as to it is going more than 12 months, that is the total number of months is going more than 12 months, how can that be? It can definitely be, so don't worry. So here the total months are 15, out of which 3 months is in the pre and the 12 months is in the post. So 3:12, to short it down, it will be 1:4. This is the time ratio. Any doubts with the calculation of the time ratio? It's quite simple. You consider the 3 dates and you write down the 3 dates. First, when the business was actually taken over, it was taken over on 1st of Jan. And then what happened? When was it actually registered or incorporated? It was done on 1st of April. And then till when the books were carried on, till when the business was carried on, it was carried on till the next year, 31st of March. So those are the 3 dates we have written. And then the difference, the pre-incorporation period is from the difference between date 1 and date 2. That is 1st of Jan to 1st of April. How many months? Jan fully, February fully, March fully. You are not supposed to consider April because it is 1st of April. So 3 months here, and here it is 1st of April to the 31st March of the next year. So it is one solid year. So there are 12 months in a year. Since you're writing this to be 3 months, you are supposed to write this as 12 months only. So you cannot ask me, or if you have a doubt, stating that, why madam 12 months? I'll write 1 there. So 3:1. So that is the ratio. No. It always has to be in an equal way. When you write 3 months, here it has to be also in the form of months. So 3:12. So when I do it or divide it by 3, it will be 1:4. Is this clear? Good. Brilliant. So the time ratio is 1:4. So what is the next ratio that we are supposed to calculate? It is the sales ratio. Working note 2 is the calculation of the sales ratio. So how do you calculate the sales ratio? As I was telling you yesterday, it might be straightly given in the question, like in form of few questions they have given. But in the most of the questions where they will test you is only in the sales ratio. So they will be giving you so much dribble, trouble, so all that will be there. So now we go back to the sales ratio. Illustration number 4, we have studied the first paragraph of it and we have calculated the time ratio. One more adjustment which comes from reading this first part of the question is the interest on the purchase consideration. So that also is there. That will come as the working note number 3. So since our standard format of doing the working notes is first working note for time ratio, second working note for the sales ratio, I am doing the sales ratio next. So in order to know what actually the sales ratio is, please read the data below the table. Okay. Okay. The company's only borrowing was a loan of 50 lakhs at the rate of 12% per annum to pay the purchase consideration due to the firm and for the working capital. So this has got something to do with the interest paid. So we'll come to this a little later. Now read. The company was able to double the average monthly sales of the firm from 1st of April, okay, the company was able to double the average monthly sales of the firm from 1st of April. So what is the meaning? So when you start writing here, you have to form an equation to understand what is the unknown variable and solve it first, correct? So here simply it has been mentioned that the company was able to double its sale from 1st of April. Now, as per the time ratio, what is this 1st of April? It is the date of incorporation, correct? So from 1st of April till the next year 31st March, every month the sale was double than what was the sale from January, February and March. So now how will you construct the equation? It will be, let the sales for a month for pre-incorporation period be X. Let the sales for a month for the pre-incorporation period be X. Correct? Now, come back. If this is going to be X, then the sales for a month of post-incorporation is going to be double. Post-incorporation period is going to be double. So it is X into, yes. So it becomes X into 2. So it is clear. Now to arrive at the sales ratio, with this particular monthly sales, you are supposed to multiply with the number of months. Clear? So how many months in the pre-incorporation? It is 3 months from your time ratio. How many months in the post-incorporation period? It is 12 months. Per month, what is the sales in pre-incorporation? It is X. And in the post-incorporation, it will be double. So it is 2X. So it will be 3X is equal to 24X. In other words, we can cancel and we can divide it by this, then write it. So divisible by 3, it will be 1:8. Is this clear? So it will be 1:8. So the next ratio that we have found out is the sales ratio, which is 1:8. It is pretty simple. This question actually is an exam question, and it has been very straightforward with regard to the calculation of the sales. So it is very, very simple. They are just telling you the sales per month has doubled from 1st of April. 1st of April is your date of incorporation, correct? So from 1st of April, if it has doubled, it means the pre-incorporation period per month the sales will be X. And post-incorporation per month the sales will be X into 2X, because it has doubled. To arrive at the sales ratio, you have to multiply the sales value per month into number of months. In the pre-incorporation, 3 months. In post-incorporation, it is 12 months. So it will be 3X is to 24X. 1:8 will be the sales ratio. Is this clear? So this is the second working note that we are doing. Yes or no? Clear? Good. So then we go to the third working note. What can be the third working note? So there are series of things that is being given. So you will tell me, madam, third working note is what we have to understand, or we have to do the interest payable to the vendor, correct? So you will have to do the interest payable to the vendor. Good. So shall we do the interest payable to the vendor? That is your working note number 3. Calculation of the interest payable to vendor. Because when we were reading the first part of the question, we calculated the time ratio, and we also had the information that was pertaining to the payment of the purchase consideration at a later date, correct? So we will go with the working note number 3 as this: interest payable to the vendor. Is that clear? So for this, please read. So what is the interest that is being paid? Please go to the first part of the question and please read the last but third line. Meanwhile, the business was continued on behalf of the company and the consideration was settled on that date. Okay. There is a doubt that is being asked. So when we come to the bonus issue and thing, I know rights issue will be a little difficult. So I'll explain. Don't worry. Okay. So you're coming back to this question. The company, the purchase consideration was settled on that day. What do you mean by purchase consideration settled on that day? That day means it is 1st of April. So when you look at this particular point, it means that the interest that was being settled is on 1st of April. That is after post incorporation, there is nothing. Interest is not being paid. Only everything, whatever interest is being paid is the pre-incorporation. So technically, you don't require anything to be computed because it is already been given to you in the question. Clear? So now you will have to understand how much will be the interest paid to the purchase consideration. I mean, interest paid on the purchase consideration, for which all of you please come to page number 5.13. Okay. Inside the table, please look at the particular last but one item. It says interest. What does it say? It says interest. Clear? All of you are there with me? It says interest. Now that can be taken here. I can show you the working note for that. Is that clear? So how much is the total interest as per the P&L given to us? Total interest as per P&L account. It comes to 9,51,000. Clear? So you know something that is already available in the question, which is 9,51,000 is the total interest. Now, what is the thing that I have to find out here, ma'am? Since you are telling me interest paid to the purchase consideration is completely for the pre-incorporation period, then what is the thing that I'll have to do here? It is very simple. Out of the 9,51,000, it is the interest, total interest. So it has two things. What are the two things? First thing is it has interest payable on the purchase consideration, which is already being paid. It also has interest that is payable by the company. Please read that particular adjustment below the table. The company's only borrowing was a loan of 50 lakhs at the rate of 12% per annum to pay the purchase consideration due to the firm. Correct? So the company's only borrowing. So what is the company having? The company is having a loan on which it is paying the interest. So you are supposed to find out of the 9,51,000 total interest, how much interest the company has paid. So when you tell the company has paid, it will be a post-incorporation expense, correct? So out of the total, if you just find out how much the company has paid as interest, it will be a post-incorporation expense. And what will happen to the remaining expense out of it? It is nothing but the pre-incorporation interest paid to the vendor as interest on purchase consideration. It is as simple as that. Till now, the yesterday's examples and illustrations, we have seen a different working note for computing the interest, that is for allocating the interest on the purchase consideration. What was it? As I was explaining to you all earlier, if there is going to be an adjustment with regard to the interest that is payable to the vendor on the purchase consideration, you are supposed to open a separate working note. Why, madam, separate working note? You are supposed to open the separate working note to ascertain the ratio which is different. It does not get allocated in the time ratio. It does not get allocated in the sales ratio. So in what ratio does it get allocated? That is why you were opening the working note. In that you understood what was the date of takeover and then what was the date on which the purchase consideration was paid. The interest on which when was paid, correct? So you came and arrived at the total months, and in the total months, you then arrived what is the pre-incorporation, what is the post-incorporation. This is what we have understood from yesterday. Sums can be asked even like that also. And this is one peculiar thing that you're seeing in the illustration number 4. And this is an exam question. What, madam, what is the difference? You can ask me. What is the difference is, here they say clearly, the interest payable to the vendor on the purchase consideration is settled on the same day as that of the incorporation date. Correct? So when it is settled on the incorporation date, is it there post? It's not there. So obviously the interest will be coming only from the date of takeover, which is 1st of January, till the date of payment, which is 1st of April. So that 3 months they are paying the interest. That particular interest paid is completely pre-incorporation interest. Now you can ask me, how do I compute that pre-incorporation interest? For which I have started explaining to you. Yeah, so we have a doubt here. Definitely. The entire 9,51,000 that is being given in the question is not post. That interest has got both post as well as pre. Now your working note is to show how much is for pre and how much is for the post. Now when I talk about something called as post incorporation, all the expenses pertaining to the company in specific will be post, right? Yesterday we understood director's fees, preliminary expenses, debenture interest, any underwriting commission, all this is completely post incorporation because only after the company has come into existence, all these expenses were incurred. The same way, in the total interest also, a portion belongs completely to post and portion belongs to pre. Now, you are supposed to find out what is post and what is pre. That is what we are explaining. Now, how will you find what is post? Please read that adjustment below the table. 5.13, please read the adjustment below the table. The company's only borrowing was a loan of 50 lakhs at the rate of 12%. So, shall we calculate the interest paid by the company? Good. How will you calculate? What is the formula for interest? Principal into rate into the time. Let's go with the simple interest. So, what is the principal amount? What is the loan amount? Which is the 50 lakh rupees. Then, how much is the interest? 12% per annum. Correct? No? The company's only borrowing is this particular loan. When did the company come into existence? When did the company come into existence, or when was it registered? On 1st of April. And if you read it further, why this loan was taken? This loan was taken to pay the purchase consideration due to the firm. So when was the purchase consideration settled? On 1st of April. How it was settled? By taking this loan. So what is the date of taking the loan? It was on 1st of April. Clear? So when are you closing the books? On 31st of March. So how many months it was there in your books? Or how many months it was there? It was there for 12 months. So it will be 12 divided by 12. Clear? It was there for 12 months. So generally it is nothing but 12 by 12 is 1 year. That's all. That is the logic. Now 50 lakh into 12%. How much is the total interest that is payable by the company? How much is the total interest that is payable by the company? So it comes to 6 lakh rupees. Clear? Now, out of the 9,51,000, the company is paying 6 lakh rupees. So, what is the pre-income? So, this will be completely taken into post-incorporation. And the pre-incorporation will be how much? The total of 9,51,000 minus whatever is the post, which is 3,51,000. So, this is how you are supposed to estimate the same. Okay, so any doubts you have with this? Now did you understand? So yeah, 9,51,000 is completely not post. So when you look at this particular example, this particular computation of interest, division of the interest between pre and post is a typical working note that we have to look into. Okay. Earlier it was just they will give you interest paid on purchase consideration, total amount will be given in your P&L, and then you will put a working note to understand how many months in the pre, how many months in the post. So that was one kind of questioning you with the interest part. Second kind of questioning you with the interest part is in this problem. They'll give you the total interest. In the total interest, they will say the company had to pay so much of interest. So that I have computed. The interest payable by the company is the loan they have taken as of or on 1/4 to settle the purchase consideration. Correct? On 1/4 the purchase consideration was settled, and the loan of this 50 lakhs was taken to settle the purchase consideration only. So it becomes very clear and evident that this 50 lakhs at the rate of 12% was taken on 1st April. So from 1st April, that fellow had to pay interest for all the 12 months, and the books are closed on 31st of March. So it will be 12 divided by 12, or rather you can take it as 1 year. So 50 lakhs into 12% is 6 lakhs. This 6 lakh is paid by the company, and it is a completely post-incorporation interest. So what will be pre-incorporation? The total minus the post-incorporation will be pre-incorporation. Is that clear? So your calculation or the working note number 3 is the calculation of the interest into pre and post incorporation. Clear? So now we go back to the next working note. If you read generally in our questions or whatever examples we solved till yesterday, we had to do maximum of 2 working notes and the interest came as third. But in this question, there is a thing wherein you will have to do other working notes. So I was just telling you the working notes will depend on the question. They are all question specific. If the question is asking you to calculate further working notes for few of the expenses, you are expected to do that. Clear? So what are the 3 working notes we have done? Time ratio, sales ratio. Third one, interest allocation between the pre-incorporation and the post-incorporation period. Is that clear? Now we go to the next one. What is the next one? Please read the next line. The company was able to double the average monthly sales of the firm from 1st April. Correct? Till that we finished the sales ratio. Please read the next. But the salaries tripled from that date. So what does this? You go into the next working note. Working note number 4, calculation of ratio for allocation of salaries. So generally, how are you allocating salaries? Tell me. Salary is a fixed expense, and all the fixed expense in relation to time will be calculated or appropriated on the basis of time ratio. But here what has happened? Clearly in the question, there is an adjustment with regard to the salaries. They say, I don't want to give the question easily to you. So what you do? Increase the number of working notes. Do another working note to find out a specific ratio for the allocation of the salaries. Is that clear? So they say, from 1st of April, the salaries have tripled. Clear? So it is the same way. How did you do sales? The same way you have to do. From 1st of April, the salaries have tripled means let the salary for a month for post-incorporation, pre-incorporation. So pre-incorporation period be X rupees, correct? In the pre-incorporation per month, let the salaries be rupees X. Now, if that is going to be the case, the salary for a month for the post-incorporation period will become thrice. So that was double, this was triple. Will be 3 into X, which is, that was 2X. Salaries was double, and this is the it is triple. Clear? Now, how will you do the ratio? How will you calculate the ratio? Simple, like what you did in the sales ratio. Now, multiply it with number of months. So, for the pre-incorporation period, the monthly sale or monthly salary was X. Into how many months in the pre-incorporation? 3 months. Now, what happened to the salary in the post-incorporation for a post-incorporation period? It became 3X because it got tripled. Into how many months are there? 12 months are there. So it will be, when you solve the equation, 3X is equal to 36X. In other words, 1 is to 12. You are supposed to divide the salaries in the ratio of 1 is to 12. Clear? Any doubts with this? You are doing the 4th working note to find out the ratio for the appropriation or allocation of the salaries. Salaries generally, if nothing is being mentioned, you will be giving it or allocating it in the basis of the time ratio. Correct? So, but now what has happened? They have given you an additional adjustment telling, don't do it in that ratio. We are giving you another adjustment. Please find out. So, the adjustment that is given to you is from 1st of April, the salaries have tripled. That is 3 times. So post pre-incorporation from 1st 1/4 it becomes post. So before 1/4 the monthly salary let it be rupees X. And after post-incorporation the monthly salary becomes 3 times of X, that is 3X. Yes. And then in order to arrive the actual ratio, you are supposed to multiply it by number of months. This was earlier seen even in the sales ratio also. So how did you do sales ratio? The same way. So it will be X into 3, that is the pre-incorporation, and then 3X into 12 months, that is the post-incorporation period. So the total amount will be 3X is to 36X, that is 1 is to 12. So the ratio for the salary will be 1 is to 12. All of you clear? And then we go to the last part of the question, which is again a peculiar thing or a peculiar adjustment. What is the peculiar adjustment? Can all of you read it with me? Can you read the question along with me? Yes, what is that? It had to occupy additional space from 1st July for which rent was 30,000 per month. So this adjustment has got something to do with the rent, correct? So this adjustment has got something to do with the rent. So the working note number 5 will be calculation of rent for pre and post incorporation period. Pre and post incorporation period. Clear? So now we are going to read and going to see what is the actual thing. So it says, I will once again read the adjustment. All of you please follow. Page number 5.13. It had to occupy additional space from 1st of July for which the rent was 30,000 per month. Which means that for the entire period of the 15 months, this particular business was under rent. That is, it was in a rented building, and they were supposed to pay the rent. So how much is the total rent that is already being paid? It is there in that particular box. Please look at your P&L. In that, the amount before the interest, office cum showroom rent. So that will be your starting point. Total rent, which is the office cum showroom rent. Office cum showroom rent. So how much that comes to total that is given in your P&L extract in the question? It is 7,20,000. Is this clear? Now it is your duty to find out how much in the 7,20,000 is completely post and how much is pre. That's all. That is your exercise. Like how you found out the interest, the same way you are supposed to calculate for the rent. So the first point for you to calculate will obviously be what is the total rent. If you know what is the total rent only, then you can proceed. What is the adjustment that is given to you? It says additional space was being used from when? From the month of July. That means additional rent was from which date, ma? 1st of July. Till which date? Obviously the end of the year. That is till the closure of the books. How many months are there from July to March? It is July, August, September, October, November, December, Jan, Feb, March. So there are 5 plus 4, 9 months. Clear? So what happens? Total 9 months. For 9 months, how much is the rent they have paid? How much is the rent per month they have paid? They have paid 30,000. That is already given to you in the question. So this 2,70,000 is something which pertains only from the month of July. Was this there from the beginning? No. But total rent is something that you paid from the beginning. Out of the total rent, something you have paid only from July, which is the additional space you have occupied, for which you have ended up paying 30,000 more. So you know what is the additional rent you have paid. So the first step will be, out of the total rent, subtract the additional rent. So for finding out what is the additional rent, what is the information that you need? Rent per month you need, which is 30,000 rupees. And for how many months or from which month he has come? From 1st of July, he has come or occupied the additional space. So it starts from July till 31st of March. You have 9 months. So 2,70,000. I think I'm writing a little small. Okay. From July 1st, 30,000 to be paid each month. So it comes to 2,70,000, which is the additional rent. Correct? So from 7,20,000, I'm going to subtract 2,70,000. How much it comes to? 4 lakh. And now what is this? This is the total rent paid for the total period. Now you will ask me, madam, additional rent though we have subtracted. That is okay. But where should we show the additional rent? Now you tell me, where will you show the additional rent? Additional rent is from which month? It is from the month of July. So now tell me, from July means, will it come in the pre-incorporation or will it come in the post-incorporation? Without any doubts, it will come in the post-incorporation, because your company has been incorporated from when? 1st of April. When have you taken the additional space or the additional rent that you started paying is from 1st of July. So the entire rent of this 2,70,000 is a post-incorporation expense. Clear? So out of 7,20,000, 2,70,000 is the additional. which belongs completely to post-incorporation, which you have found out. So this is separate. Now remaining 4,50,000 is the rent that has been paid for, or paid from when to when. This is the rent that is paid for the total period starting from 1st of January till the next year 31st of March. Yes, till that of 31st of March. Now tell me, generally, how will you allocate the rent? In what ratio are you going to allocate the rent? You have to allocate the rent, since being a fixed expense, in the ratio of time. Rent has to be allocated in the ratio of the time. So the remaining 4,50,000 will be allocated in the ratio of the time for pre and post incorporation. How will you allocate it? What is the time ratio? 1:4. So it will be 1 divided by 5 into 4,50,000. And for the post incorporation, it will be 4 divided by 5 into 4,50,000. Is this clear? Pre and post. Here the only thing that we are doing is, out of the total rent, generally if the rent is given, you will divide it in the time ratio of 1:4 and finish the sum. But in this question, you have an additional adjustment that is given, stating that out of the total rent, don't split the total rent in the time ratio first. There is something which is belonging fully to the post incorporation. First subtract that. And whatever is remaining, this completely it belongs to the period beginning from 1st January. So this can be given in the time ratio. So now tell me, when I talk about pre, when I talk about post rent, how much in the pre-incorporation? 1 divided by 5 into 4,50,000. This comes to 90,000, which is your normal rent. Correct? Normal rent comes to 90,000, which is 1 divided by 5 into 4,50,000. The same way, 4 divided by 5 into 4,50,000 is 3,60,000, which is the post-incorporation period rent. Clear? Now, is the sum over here? No. In post-incorporation, this amount of rent also I have to take. So that is, there is nothing for the pre-incorporation. Only for post-incorporation, we have 2,70,000. So what is this total put together? It comes to 6,30,000. Yes, 6,30,000 is the rent for post-incorporation, and 90,000 is the rent for the pre-incorporation. So that is the only adjustment that you are supposed to take care. And please read after this, read the question after this. Prepare a statement of apportioning cost and revenue between pre and post incorporation and find out the profit or losses for such periods. Is this clear? So we have solved first the working notes for illustration number 4. Okay, so illustration number 4 is a very simple and it is an exam question. What is being asked to you is, some things are simple and some things you have additional working notes to be done. So standard format, what is the working notes you will have to do? First is the time ratio and then is the sales ratio. So it was easily done. Time ratio, they have told you from 1st of January till the 31st of March next year, and in between the incorporation happened on 1st of April. So it was 3 months in the pre-incorporation and 12 months in the post-incorporation. I told you some of you might get a doubt as to it is more than 12 months, madam. So how can we have it? No problem. It's not our problem. It's just the number of months and allocation. Till now we have seen 12 months getting divided, and here it is 15 months, which is more than 12 months. So you can definitely have it, not an issue. Clear? So 1:4 will be the time ratio. Now sales ratio. It is very simple. Sales ratio, they have told from 1st of April, the sales doubled. So that will be for the post-incorporation period, per month, the sales will become 2x. For pre-incorporation period, it will be x. Now multiply with the number of months and then you arrive at the sales ratio to be 1:8. Is that clear? And the next working note that we did for is interest part. Apportioning the interest, how much of the interest belongs to the pre-incorporation period and how much of the interest belongs to the post-incorporation period. For the pre-incorporation period and for the post-incorporation period, there was one adjustment that was given for you to identify. It said the company had only one borrowing of 50 lakh rupees that was taken to settle the purchase consideration. So when was this purchase consideration settled? On 1st of April. So it becomes very clear to you that the 50 lakh rupees is the loan that is being taken by the company and the purpose is only for the company. So you have started calculating it and finding it out that 50 lakh into 12% into 12 months, 12 divided by 12, that is for 1 year. So 6 lakh rupees was the interest which belonged to the company. Company means post-incorporation. So out of 9 lakh 51, you subtract 6 lakhs. So 3 lakh 51,000 will be the pre-incorporation period interest. That is your working note number 3. Working note number 4. In the working note number 4, you had to find out a ratio for the salaries. Generally, salaries is a fixed expense, but since this is going to be, generally salary is what? It is a fixed expense, correct? But if it is going to be a fixed expense, time ratio may you will allocate it. But now they have given you for the salaries also, don't go with the time ratio. I am giving you my adjustment, calculate. So it says the salary is tripled from that particular date. So in that case, you have found out 1:12 is the salaries ratio. And the final and the last adjustment is with regard to the rent. Generally, rent also like salary should be given in the time ratio. But here they have given you an additional adjustment for you to work out, wherein they say, during the post-incorporation, additional space was occupied. That is from a particular date. Here it is 1st of July. So from 1st of July till the closure of the books, you have 9 months. So for the 9 months, additional space, rent comes to 30,000 per month. So first, that particular rent has to be deducted, correct? So out of the total rent, 2,70,000 was completely in the post-incorporation. That is to be eliminated first. Remaining whatever rent is there, that is for the entire period from the 1st of January to 31st of March. And that has to be given in your original normal ratio of time because it is a fixed expense. So when you split like that, you get 90,000 in the pre-incorporation and 3,60,000 in the post-incorporation. But with that, the sum is not over. All of you should remember where this 2,70,000 also will come into the problem. Please group it under post-incorporation period rent. So the total rent for the post-incorporation will be 6,30,000 and 90,000 will be for the pre-incorporation period. So with this, we are through with the question. You are supposed to do the last part of it. See, since all of these are like say easy questions, I don't want to waste time. So let me cover as much as possible. Only adjustments, if I'm going to explain it to you, you will be able to do it. Also, I'll give you my handwritten notes so that you'll be satisfied. Okay. So the handwritten notes will be shared by tomorrow. All of this is clear. Now, what will you do for the final presentation? Since all the 5 working notes have been made behind, now you come to the final presentation. Statement showing the appropriation of the pre-incorporation and post-incorporation period profits or losses. That will be your heading. And it has to be a 5-columnar table. The first column should have particulars. And then the second column will have the total amount. The third column will have the ratio. Then it will be pre-incorporation amount in rupees, post-incorporation amount in rupees. Is this clear? With what will you start? Where is the question starting? What is that? It is starting. You have sales. You have cost of goods sold also. Clear? I have told you generally the starting point for any such question will be the gross profit, and the computation of gross profit can be of 2 formulas. The first formula is sales into gross profit percentage, or it can also be what? From the net profit you can arrive at the gross profit. I have given you a formula for that also. In this question, if you look, it is sales is there, cost of goods sold is also there. So what can you do? Arrive at the gross profit separately, and then the gross profit has to be given in what ratio? It has to be given in the sales ratio because it is a variable. It is a variable income related to the sales. Clear? So you can do like that, and then you will write less expenses. What are all the expenses? Can we have a fast recap? First one is the salaries, which is 11,70,000. Generally, salary should be given in time ratio, but now will you do time ratio? No. You have found out a separate ratio for the salaries, which is 1:12. So you're supposed to allocate it in the ratio of 1:12. Then comes depreciation. Depreciation in what ratio? It is fixed expense, so it will be in the ratio of the time. Good. Advertisement. Advertisement is in what ratio? It will obviously be in the ratio of the sales. Discount, variable with sales, so sales ratio. Managing director's remuneration. This is completely a post-incorporation expense because he's a director. Miscellaneous office expenses. Any office expenses are fixed with time, so they will be allocated in the time ratio. Office cum showroom rent. You have to give the reference to working note number 5. Office rent, office cum showroom rent, pre-incorporation will be 90,000, post-incorporation will be 6,30,000. Good. And the final part is interest, which is working note number 3. Pre-incorporation will be 3,51,000. Post-incorporation will be 6 lakhs. Clear? After you do everything, what should be the last line? It should be net profit. Total, how much is the net profit? And that net profit, how much will be net profit or net loss? How much will be pre-incorporation? How much in the post-incorporation? With that, the sum is over? No. There is one note, final note, which you have to give. If there is a pre-incorporation profit, you will have to take it to the capital reserve. If there is pre-incorporation loss, the same will be taken to the goodwill account. Clear? You need not actually mention anything about the post-incorporation in specific. They will not ask you because they know post-incorporation, so it will be taken, or it is a balance of the P&L account, and that will be taken to your what? It will be taken to your balance sheet and added with the reserves and surplus. All of you clear with this? Can we go with the next illustration? See, after illustration number 4, they have given illustration number 6. Okay, so there is a printing mistake. So this is actually illustration number 5, page number 5.15. Okay, before this, just 2 minutes, I'll take one thing. Sorry to interrupt. Now my schedule covers only company accounts. If possible, please explain markup down concepts in department accounts and branch accounts chapter 1. Okay, there are so many requests with regard to the branch accounts and the department accounts. So definitely I'll schedule a class for that as well as for amalgamation. Okay, so I am not sure if partnership I can handle it within this particular less time. So everybody has got a problem with your branch accounts and department accounts, which is actually very easy. So I will just do it. Okay. And I'll let you know when that class will be scheduled. So for now, I'll be finishing this and I will start off with the bonus issue. So I would like to do at least minimum of 3 problems in the bonus issue. And the behind problems, the practical questions in the bonus issue is the same as what we are going to solve in the illustrations only. So that will be actually very easy. So it shouldn't be a problem. Okay, now back to our question. Okay, we are going to do the illustration number 6 on page number 5.15. All of you with me? Yes. Let's start. And for this also, I will be actually orally telling things to you, but wherever a working note is required, we'll be working out here. And then I will explain what is to be done, like your final presentation. But I want all of you to please try. It is only by trying and practicing. It is only by trying and practicing that you will be able to do or excel in accounts. So in accounts, there is no shortcut. First thing is don't buy heart. Okay, I've seen people by hearting this only, this only, this only, this only. No, you are not supposed to read accounts, as you can see from or throughout my sessions. I have been telling only this. Don't buy heart. Understand the concept. After you understand the concept, it is equally important you solve it. I will tell so many things in the class. It will be like, I've understood, madam, class is super, I've understood that this is. If you don't practice the same, madam, you will scold me later before exams when you are starting to revise. You will scold. So that to have that grip over the accounts, you will have to definitely practice. Is it clear? Not only me, anybody. So anybody or everybody who teaches you, you have to practice. You have to take your initiative. Then you will be able to do. Clear? And that maintaining of time will come only when you keep solving a lot of illustrations so that you will improve on your presentation. It is clear what is required for the answer, so you will write. You will also know how to manage time, which is why you are supposed to what? Practice. Good. Illustration 6. ABC Limited took over the running business with effect from 1st April. Okay. So 1st April is the takeover date. The company was incorporated on 1st of August. So we have gone back to our original, very comfortable and nice one. 1st April, 1st of August. The following summarized profit and loss account has been given to you for the year ended of 31st March. Correct? So it has been given for the year ended of 31st of March. So now can we visually do the time ratio? Yes, we can do it. What is the takeover date? 1st of April. What is the incorporation date? 1st of August. So what is the date of closure of the book? So it is 31st of March. So there are only 12 months in which 1st April to 1st August is the pre-incorporation. 1st August to 31st March is the post-incorporation. So how many months it is? How many months it is? 4:8. So how much is the time ratio? Time ratio will be 1:2. Good. Now, please read. So everything. So starting point is the gross profit in this particular thing. So there is straightly given to you in the question. Gross profit will be divided in which ratio? It will have to be divided in the sales ratio. So to find out what the sales ratio is, we will go directly to the what do we do? We'll go directly to the notes itself. Okay. So now calculation of the sales ratio is a peculiar thing in this particular problem. Now we are doing illustration number 6. In that, we are doing the working note number 2. Working note number 1 is over time ratio. Working note number 2 is what we are going to do now. Illustration number 6. Good. So what does the working note tell? Please take, all of you, please read the additional information. Point A. Total sales for the year which amounted to rupees 19 lakh and 20,000. Calculation of the sales ratio. Correct calculation of the sales ratio. In the sales ratio, how much is the total sales? What is he saying? Total sales for the year amounted to rupees 19 lakh and 20,000, which arose evenly up to the date of 30th September. Do you remember our illustration number 1, wherein we have done separately for the sales, wherein we took first half year, second half year. You remember, for the first half year, the sales were so much. The second half year, again, you did in relation. It is also a similar problem like that. From 1st April, simple no? From 1st of April to 30th of September, the sales rose evenly. That means let us consider the monthly sales to be how much? X. Clear? The monthly sales to be rupees X. That is from which and which period, ma? From 1st of April to 30th of September. Clear? From then what happened? Please read. From thereafter, they recorded an increase of 2/3, recorded an increase of 2/3 during the rest of the year. That is from 1st of October to 31st of March. What has happened to the sales? 2/3 of X has increased, correct? So if you have, by dividing 6 months, correct. So now what are you going to do? You know that there was X was happening for the first 6 months, monthly sales. Then what happened? It increased by 2/3. That means X plus 2/3X. Is this clear to you? Whenever you start doing, till now you had very simple, either it was half, either it was double. That is what you have understood. Half means we did into 1/2, then we took that as 0.5 and we finished the problem. But here, instead of doing that, this 1/2 is given in another fraction. He says it has increased by, when you say increased, it is increased by so much of amount. So originally X was there. That plus 2/3 of X, it has increased. So when you solve this, what will happen? The total will be 3. 3 plus 2. So it is 5/3X. So the monthly sales from 1st of October till 31st of March was 5/3X. This is clear? Any doubts up till this? Because that is the one thing you have to understand very much. So it was 5/3X. Okay, that was 5/3X. Clear, all of you? Good. Now, how will you arrive at the ratio? This ratio is clear only, correct? This ratio is clear only. How will you arrive at the particular ratio? There is one more method of doing it very, very simply. Shall I tell you that method? Yes. Now, from 1/4 to 39, how many months, ma? 6 months. From 110 to 31/3, how many months, ma? 6 months. So what we will do, we will find out what is the sales per month first. Okay, you know what is the total sale, which is 19 lakh and 20,000. And then you have arrived at for first 6 months, per month sales is X. So for the first 6 months, how much the per month sales comes to? X into 6. That is per month is X, and for the 6 months, 6 into X. So, yes, any doubts? Then, now coming back, the second part of the 6 months will be what? X becomes 5/3X here. So 5/3X into 6. So you can cancel this into 2. So it becomes 10X. You're able to see till this? Okay. So it will be 5 divided by 3 into 6. So it will be 10X. Till this it is clear? I'm telling you another way of doing it. The last problem in the illustration 1, what did we do? We put April, May, June, July, August, everything we put like that. Then we wrote individually. And then we found out how much in pre-incorporation period we added that. How much in the post-incorporation we added that. That is one way of doing, which already I have explained to you in the illustration number 1. Now the second way of doing, making life easy for you when you have so much fractions like this, you can do it in another easy way. What is that another easy way? First find out how much is the monthly sales. So for the first 6 months, monthly sales is X. For the next 6 months, the monthly sales is 5 by 3x. So first multiply. So 6 months ke liye 6x, the next 6 months it becomes 10x. So now what is the total sale? 6x plus 10x, correct? So 16x is equal to ultimately what? 19 lakh and what? 19 lakh and 20,000. So 16x is equal to 19 lakh and 20,000. So how much is x? X is equal to 19 lakh and 20,000 divided by 16. So for per month it will be 1 lakh and 20,000. Per month it will be how much, ma? Are you able to see this? Okay, I've gone a little bit down. 1 lakh and 20,000. So per month, not 19 lakh and 16,000, 20,000 divided by 16. It will be 1 lakh and 20,000. Have you arrived? So 1 month sales is how much? 1 lakh and 20,000. So now X is 1 lakh and 20,000. Now coming back, how much in the pre-incorporation? I'll write it this way. How many months in the pre-incorporation? First 4 months, correct? That is from April, May, June and July. So first 4 months it comes in the pre-incorporation. So you can take it like this. 1,20,000 which is X into 4 months. So it is 4,80,000. Clear? Pre-incorporation it is 4,80,000. Now you will ask me, madam, again 1,20,000 into 8 shall I do? You are not supposed to do like that because till July or the first 4 months only is X. After that, in August and September also it was X. Correct? Then it started becoming 5 by 3x, 5 by 3x, 5 by 3x, 5 by 3x. So in order to avoid this confusion only, I have asked you to first do it like this and find out what is X, which is 1,20,000. Now 4,80,000 is for the pre-incorporation. So post-incorporation in a simple way you can do total sales minus pre-incorporation. What is it? Total sales minus pre-incorporation. You can do it. That is an easy way of doing. So 19 lakh and 20,000 is the total sales minus pre-incorporation period is 4 lakh and 80,000. Clear? 4 lakh and 80,000. So if you subtract that, you will be getting 14 lakh and 40,000. Clear? So now the sales ratio will be 4,80,000 is to 14 lakh and 40,000, which is 1:. So all the zeros will go away. 48, 144 goes 3 times. So it is 1:3. All of you, any doubts with this? I have actually explained illustration 1 to you in doing the particular months. If you want, we can also solve this 1:3 in that also, in that way also. Can we solve that and see if all of you are comfortable with it? We can also do that, okay? How did I do? I think all of you would have seen this 1:3, okay? That arriving is okay with you. Now, how I have done earlier, if I'm going to do in that method, am I going to still get 1:3 is what I'm going to check now, okay? So it is also being divided into 1/4 to 33. So it will be April, May, June, August, September. Okay, and then the next 6 months begin from October, November, December, Jan, Feb. This is how I did illustration 1, if you were following. So coming back, I'm also again going to do and show you. Even in that way, it is going to be the same. Yes. So for the first 6 months, how much was the sales, ma? It was X. So it will be X. Yes. For the next 6 months, how much the sales became? It became 5 by 3x, 5 by 3x, 5 by 3x, 5 by 3x. Yes, this was the thing after that is the post incorporation, that is the next 6 months ke liye it was like this. Now out of this you are supposed to tell me what is what. Now coming back, first 4 months till this period it is the pre-incorporation, and from this it is the post-incorporation, correct? This is pre-incorporation, this is post-incorporation. Now, how will you arrive at the ratio? Shall I write here? Is it visible? Okay. Pre-incorporation is X into 4 months is 2. Post-incorporation has two things. First, X into 2 plus 5 by 3X into how many months? These are 6 months. So, this is the ratio. 4X into 2x plus 5 by 3 into 2 will be 10x. So, okay, I'm going a little below. Okay, so I have solved this. So, it will be 4x is to 12x. When you strike it off, 1 is to 3. Actually, this is better method, no? Very easily it is over. Instead of doing a lot and then arriving it, please follow this method. Okay? So it is a pretty easy method and it is actually a time saving method. So don't please waste your time. Go to this. Till this, whatever you have done is right. Okay. Till this, though, you have to do it in every question. You need to know how the sales have been divided. That is first 6 months and next 6 months. Yes. Now coming back, do it this way. So first 6 months ke liye, the first thing was X and then it increased by 2/3. It increased by 2/3. So it will be X plus 2 by 3X. Some of you might make a mistake of just taking this as 2 by 3X only. But that is not the question. He says it records an increase of 2/3. X is there originally and again 2/3 of X also is increasing. So total increase or the total monthly selling for the next 6 months is 5 by 3x. That is where you might make a mistake. Then others you can already do because in the illustration 1 I have told you. So the sales ratio comes to 1 is to 3. All of you clear? Sales ratio comes to 1 is to 3. Good. Time ratio is 1 is to 2. Good. Now please read the next part of it. Rent of office building was paid at 2,000 rupees per month up to September, and thereafter it was increased by rupees 400 per month. So it is obviously a very easy thing. So I want all of you to like try. So what they are saying, from 1st April to 30th September, 2,000 into 6 that was being paid, and then what happened? Then it became to 2,400. So 400 was increased per month, and from 1st October you ended up paying that way. It is same like this problem only. So you have to put April, May, June, July, August, September and here. So from April to September it was 2,000, 2,000, 2,000, 2,000. I'll work out the sum here itself, okay? This is calculation, sales ratio over month. The next we are talking about rent. So how will you calculate the rent for pre-incorporation and the post-incorporation? Clear? Pre-incorporation and the post-incorporation. They say the rent up to 30th September, rent up to September means up to September is even 30th September also. So up to September was 2,000 rupees. So I will put 2,000, 2,000, 2,000. And August and September also is 2,000. Thereafter, how much? The rent has increased by 400 rupees. Correct? The rent has increased by 400 rupees per month. So 2,000 plus 400 becomes 2,400. So this is the actual way. Now, how will you find out how much pre-incorporation, how much post-incorporation? The same way. I'll now show you this. It is the same way. Instead of putting X, you will be writing what? 2,000 rupees. And here also, instead of X, you will be writing what? For these 2 months. For August and September also, it was 2,000 only now. So it will be 2,000. From then on, how much it became? It became 2,400 into 6. So now, how much is the pre-incorporation rent and post-incorporation rent? So it becomes 8,000 pre-incorporation, and this is 8,000 plus 10,400. Correct? No, this is 4,000. Sorry, 2,000 into 2 is 4,000, and this is 14,400. So the total post-incorporation comes to This comes to 18,400 and this is 8,000. Clear, all of you see? 8,000 rupees is the rent for the pre-incorporation and 18,400 is the rent for the post-incorporation. So we have done the next working note, that is calculation of the interest for the pre-incorporation as well as post-incorporation period. So this is also same like your sales. For the first 6 months, one type of rent is being paid, one amount of rent is being paid, and for the next 6 months, there is an increase in the rent. So what I have done, the same formula in the same working note, I have just replaced the X with the amounts paid as rent. So for the first 6 months, 2,000 is paid. For the next 6 months, 2,400 is paid. And now I have again taken it as the first 4 months as pre-incorporation, the next 8 months to be the post-incorporation, and accordingly I have multiplied. I have got 8,000 as the pre-incorporation rent and 18,400 as the post-incorporation rent. Is that clear to all of you? We go to the next part. What is the next one? Traveling expenses include 4,800 towards the sales promotion. So what is the meaning? When you look into your example or your particular question, you have something called as the traveling expenses of 16,800, correct? So you have the traveling expenses of 16,800, out of which it is given in the question as 4,800 is for the what? Sales promotion. So anything that is related to the sales promotion will be divided in the ratio of the sales, correct? Anything related to the sales promotion will be divided in the ratio of the sales. Good. Now, sales promotion. What is the total traveling expenses? Can somebody tell me? Total traveling expenses is 16,800. Out of that, 4,800 is for sales promotion. So 4,800 will be given in the ratio of the sales. So 16,800 minus 4,800 will be 12,000. That 12,000, since they are traveling expenses, you can consider them to be fixed expenses. Now you might ask me, what, madam? Traveling expense is only for marketing? No. Traveling expenses are different. Traveling commission is different. Where you get the word as commission, discount, advertisement, promotional activities, all that will be given in the sales ratio, correct? But when you talk about traveling expenses, this can be general travel and conveyance expenses. So that should be given in the form of or in the time ratio. Generally, traveling expenses should be divided in the time ratio, correct? But now what has happened? The thing time ratio, it should be given, but you have an adjustment which says no, not time ratio alone. In the traveling expenses, I have sales promotion also included. So sales promotion, give it in sales ratio. Remaining traveling expenses, please provide it in the time ratio. Traveling expenses, that is the adjustment about it. All of you clear? That is the adjustment about. Now, what is the next adjustment? Depreciation. Depreciation is what? In what ratio you have to give the depreciation? So generally, the depreciation will be given in the time ratio because it is a fixed expense. Depreciation will be given in the time ratio because it is a fixed expense. Correct? But now what has happened? What is the total depreciation? Look into the depreciation on fixed assets is 9,600 as per your P&L. It is 9,600 as per your P&L. So 9,600 minus what has happened here. Depreciation include, read your adjustment. Depreciation include 600 for assets acquired in the post-incorporation period. So out of the total depreciation, 600 belongs completely to the post-incorporation. It is like the rent we have seen in the earlier problem, correct? Total rent, in that some rent belongs only to post-incorporation. So first remove that. And the remaining amount should be given in what ratio? Since it was rent, time ratio. Here it is depreciation, this is also time ratio. So out of 9,600, you have to not allocate 9,600 in the time ratio. But what are you supposed to do? You are supposed to first deduct the 600. You are supposed to first deduct the 600 out of the 9,600. This 600 will go into post-incorporation. And the remaining 9,000 should be divided in what ratio? In the time ratio. Okay? Good. Next, the last and the final, the purchase consideration was discharged by the company on 30th of September. So when was the purchase consideration discharged? On 30th September. When was the business taken over? So you will have to do another working note for computing the purchase consideration, interest on the purchase consideration. In the textbook or in your question, it is given interest paid to the vendor. So 4,200 is given. Now 4,200 has to be divided in the ratio. So it is like a normal problem, not like your last question wherein total interest is given and how much interest is pre, how much interest is post. Not that. It is your original question wherein total interest paid to the vendor is given, and in that interest paid to the vendor, how much is pre-incorporation, how much is post-incorporation. So when you have to do a working note like this, what will you do? You will have to do, or you will have to take the two dates, which is the date of taking over of the business and date of settling or payment of the purchase consideration, correct? So date of settling or payment of the purchase consideration ke liye, you have to check the dates. 1st April was taking over of the business and 30th September was the payment of the purchase consideration, which is 6 months, correct? From 1st April to 30th September, how many months are there? There are 6 months. And out of the 6 months, how much is pre, how much is post? The first 4 months is pre and the next 2 months is the post. So what is the ratio? 4:2. So it will be 2:1. In that ratio, you are supposed to give it. Is that clear to all of you? You are supposed to give it. Good. Okay, now I think all of you are following this, right? I just want a small quick thing from your side. All of you please open the illustration number 7, okay? All of you please open the illustration number 7, okay? And start working out the same. Just give me 5 minutes, okay? I'll be back. Just give me a 5 minutes. I need to take a water break. I'll be back. So I just want all of you to just work out. So after this, I'll just give you a briefing of how the question has to be done orally, and then you can do it. Tomorrow I'll be giving you the handwritten notes. Tomorrow means the session is going to continue. Just give me a 10-minute water break, okay? All of you, please continue doing the question. I'll come in 5 minutes. Okay, sorry, I had to take a call. So, okay. So yeah, did everybody were you trying or you just simply whiling away the time? Okay. Brilliant. So we come back to the illustration number 7. So I'll do a fast thing of it. So after finishing it for the next 2 to 3 minutes, we will then go back and we will start with the next chapter. Okay. So then coming back to the illustration number 7. ABC was incorporated on 1st of May to take over the business of DEF and Co. So when was the incorporation date? It is on 1st of May. Good. From 1/1/2000. So from 1st January, they have taken over. So the taking over date is the 1st of January. And then when was it incorporated? The incorporation date is on 1st of May. So from 1st of January to 1st of May, it is the pre-incorporation period. And a summarized P&L account is given for the year ending 31st December. So this is a calendar year. Unlike the financial year, this is a calendar year. So from 1st of January till 31st of December is given to be a total number or your total period. Out of that, what is there in the pre-incorporation, what is there in the post-incorporation? Pre-incorporation is from 1st of January to 1st of May. That is January, February, March, April till April 30th. So from the 1st of May, incorporation has happened. So you cannot consider the month of May. So it is 4 months in the pre-incorporation and 8 months in the post-incorporation. So what is your time ratio? 4:8 and 1:2. Good. The summarized P&L is as follows. The summarized P&L is as follows. So can we have a quick recap or can we just look into quickly? Okay. So what is that? The starting point is gross profit. That is 10,60,000. Correct? In the 10,64,000. Now this gross profit has to be given in the ratio of your sales. Correct? For which we have to find out the sales ratio. So leave this and then come. Interest on investments. There is an indirect income also given in the question apart from the apart from your normal gross profit. So we need to understand when these investments were held and when these investments were held and for which period they were in the books. So based on that, if it was held after May, that is from May it was held, means it will be in the pre and post incorporation. If it was held before May, then it will come in the pre-incorporation period. So we have to first read the adjustments to understand that. So this interest on investments is something that comes as an adjustment. So we have to see it in the later part of the question. Now read all the expenses. Rent and taxes. So generally rent and taxes is a fixed expense with relation to time. So generally it has to be given in the time ratio. But if you have an adjustment like in the earlier illustration, if you're going to have any adjustment, it has to be dealt appropriately in the adjustment only. The next one, salaries, including the manager's salary of 85,000 rupees. So what is this manager's salary? So we'll check out the adjustments if it is there. But generally salary should be a fixed expense and it should be given in the time ratio. Good. Carriage outwards. What do you mean by carriage outwards? Carriage outwards is nothing but once after you have you have produced the finished goods. In order the finished goods has to reach the customers, you have to pay for the transportation. So carriage outwards or freight outwards is something variable in relation to the sales. So it has to be given in the sales ratio. Printing and stationery, it is a fixed expense. So it has to be divided or allocated in the time ratio. Interest on debentures. Debentures is a post-incorporation expense since debentures can be issued only by the company. So hence interest on debentures which will be a completely post-incorporation expense. Sales commission. It has to be divided in the sales ratio. Bad debts related to sales, again sales ratio. Underwriting commission. So this underwriting commission is in relation to issue of the shares. So shares can be issued only by a company. So then it will be a post-incorporation expense completely. Preliminary expense. Definitely a preliminary expense will be a post-incorporation period. Now, Audit fees. Now, audit fees alone is given. If in the audit fees, if they tell you specifically company's audit fees, then it will be a post-incorporation expense. If they tell you it's going to be tax audit fees, then you have to divide it in the ratio of the sales. But since the question at this point is very silent, not clear, let us read the adjustments to understand what it will be. Next, loss on the sale of the investments. So it means that the investments were there, interest you have earned on the investments, and you sold the investments also, due to which you have made a loss. Now the point is, all the things related to the investment, whether will it come in pre-incorporation or to be taken to the post-incorporation, is only if you read the adjustments, you will be able to understand. So if you look at the adjustments, there are 6 adjustments. So let us go through one by one. Yes, we have already found out the time ratio. The next ratio, which is very important ratio, is the sales ratio. So before that, let us read. The GP ratio was constant throughout the year. Since already gross profit is given to you, you need not worry about this adjustment. If in case gross profit was not given, then we had to consider this to arrive at the gross profit. Now, since already you have gross profit, your botheration is to calculate only the sales ratio. Clear? Now, please come to the next point. Sales for January and October were 1.5 times sales, 1.5 times the average monthly sales. While for the month of December, there were twice the average monthly sales. Correct? So this table is not going to leave, I guess. So you will have to write a table like this, mentioning all the months. So somebody has given the answer already. Good. Was that Vaddi Markandeya? So in order to calculate the sales ratio, till now we have seen the examples wherein you had the division of the year into first half year and the second half year, correct? Now here, this is a peculiar case wherein it again talks about months. So individual months it is talking. So it is not saying one full 6 months, this only, the next 6 months fully, this only. No. In between it is talking. So when does the year begin? January, Feb, March, April. So till when can we take the pre-incorporation? Straight away we can take pre-incorporation, not required to write 6 this side, 6 that side. What is pre-incorporation? Jan, Feb, March, April. Correct? Then June, July, August, September, October, November and December. Correct? 4 months, and here it is. I forgot May. Okay, so that's why I was thinking my only 11 months are coming. So May, June, July, August, September, October, November, December. Clear? Now can we read the question again? The sales for January and October were 1.5 times the normal sales. So if the normal sales is going to be X, only for the month of January it is going to be 1.5. So 1.5x for January and October also, which is again 1.5x. Clear? And then they say, while the sales for December was twice the monthly sales. So with regard to all the other months, since your question is very, very silent, so what you will have to do, you have to consider it to be X. Let the monthly sales for all the months be X, except for January and October, which are 1.5 times X, and for December, which is 2 times X. So now if you add, what will happen? So this becomes 4.5x and this becomes 3.5. 3 plus 2, 4, 5, 7, 8.5. Are we getting the right answer? What is the answer? 9.58. Okay. In November, I've missed out the x. So it will be 9.5x. Sorry, I'm bad in maths. So it is 4.5x to 9.5x. So the ratio is 4.5 is to 9.5. So you can ask me, can there be some ratios like this, ma'am? It can be, no problem. Okay. So when you add 4.5 plus 9.5, it will be 14. So that will not be a problem. So 4.5 divided by 14 into whatever rate, into whatever is the amount that you will have to allocate. So 4.5 is to 9.5 is the sales ratio. Good. Now can we read the next one? Bad debts are shown after adjusting a recovery of rupees 7,000 of a bad debt for a sale made in July 2080. Now which year are we in? We are in 20x1, but they are talking of a bad debt recovery in 20x0. So what is this completely? So it should be a pre-incorporation period. Okay. It has to be a pre-incorporation period. Now, can we have a better explanation of this? Now, bad debts in relation to sales is how much? 91,000, which is given as an expense in your P&L account. Correct? But this 91,000, you have arrived after what? Adjusting a bad debt recovery, which was coming in the which was belonging to a pre-incorporation bad debt. Now you have recovered that particular amount. So can you still do this particular thing, 91,000? Definitely you should not. How will you be calculating with the particular thing? How will you calculate with the particular area? How will you do that? So how will you do? Anybody? How can you do the bad debts recovery part of it? So it is very simple. We will work it out here. So first you have to find out what are the actual bad debts before making such an adjustment, correct? You have to find out what are the actual bad debts before making such an adjustment. The actual total bad debts given in the question is 91,000. But in the adjustment, it is clearly given that this 91,000 has been arrived after adjusting for a recovery. That means what? Bad debts would have been much higher. You subtracted the recovery from that and you arrived at this amount. So to arrive at the actual bad debts for the year, what should you do? Add back the recovery. So you are going to add the recovery of the bad debts. How much is the recovery of the bad debts? It is 7,000. So now it comes to 98,000. Is this clear? What have I done? I have taken the bad debts total expenses, which is given in the question. I have added back the what? Recovery that has happened during the year, because I want to estimate what was the actual bad debts that I have incurred. So I have added back this particular recovery. And where will this 7,000 go? Now 98,000 is the actual bad debt. So the bad debts obviously have to be allocated in the ratio of the sales, correct? So that will go on the sales ratio, which is your points. 4.5 is to 9.5. Okay. And then coming back, this recovery is actually an income for you. But which period income? Is it post-incorporation or pre-incorporation? This bad debt of 7,000 happened in pre-incorporation, but unknowingly it came as a recovery. So you have recovered it during the post-incorporation only. Correct? You have recovered it in post-incorporation. That is no doubt. But the nature is very important. You have done this and the recovery has happened only in the pre-incorporation. So this will be shown as income in the pre-incorporation period. Is that clear? So that is with regard to this particular adjustment. Good. And the next adjustment, that is, okay, before we go to the manager's salary, we will see the last two adjustments, which are very easy. All the investments were sold in April. So when it is sold in April, obviously it is a pre-incorporation period. So the income or the interest on investments, which is an investment income, will be taken to the pre-incorporation period completely. And the loss on sale of investments will also be shown in the pre-incorporation period as an expense fully, because they say that the investments have been done in the, investments have been sold in the period or in the month of April itself. So till that particular month, we were still in the pre-incorporation period. So both the income as well as the expense related to the investments will come in the pre-incorporation period. Good. The last point, entire audit fees relates to the company. So that is very important, and it is a completely post-incorporation expenditure. Now we go back to the manager's salary. And manager's salary, where is this manager's salary? Yes, It is salaries including manager salary of 85,000. Correct? Including manager salary of 85,000. So for easy method, what you do, total salaries of 3,31,000 minus manager salary 85,000 you do. Whatever is the remaining salaries, that you please allocate it in the time ratio. Now manager's salary of 85,000, bring it separately to the working note. And now you can do, first what you have to do, out of the 85,000, what is completely belonging to the post-incorporation? They say manager's salary was increased by 2,000 rupees. From which month? From the month of May. So May, June, if you consider the manager's salary to be X rupees per month, from the month of May, it is being increased by 2,000 rupees. So it becomes X plus 2,000. Correct? So for the first 4 months, it will be X into 4. And for the next 8 months, it will be X plus 2,000 into 8. That is how you will solve the equation, and you will arrive at what is the pre-incorporation and the post-incorporation manager's salary. So with this, we finish with the, yeah, it is done. With this, we finished with this particular chapter. All the illustrations, there are 6 illustrations plus 1 example, out of which 3 illustrations I have worked out in the class, and all the remaining 3 illustrations has been explained to you word by word and adjustment by adjustment. I have maximum possible cases, I have solved everything on the board with regard to the adjustments, working notes, and I have asked you to work out the main formula, that is your main presentation. Again and again, I'm telling you, the pre and post incorporation, I hope it was actually easy to you and you were able to get a conceptual clarity on the same. So, all of you, did you find it like easy or not? So just let me know in the comments later. So this is with regard to the pre and post. And once after you do your final presentation of the answer, what is very important, I told you, the heading for the statement for the year ended, very important. Headings for each of the individual columns, very important. See if amount is given in rupees or rupees is given in lakhs. So write it accordingly, and then you will have to calculate or do the working notes. And finally, after you get the answer, you are supposed to give a note with regard to pre-incorporation profit or loss, where it will be taken. It is not sufficient or it is not enough that you are or you will only do this particular find out what is the profit loss and then leave it at that. No, you are supposed to write where the profit or loss with regard to pre-incorporation will be taken in the balance sheet. Okay, so that is how it finishes. So do we have any doubts, or this is okay? Can we start the next topic for today? Yes, can we start the next topic for today? So I just wanted to have a very quick feedback, like were you able to find it easy, or anything that needs to be like improved in this particular thing. I will be sharing the handwritten notes, ma'am. Okay, I'll be sharing it in the tomorrow's link for this particular chapter. But almost all I have solved everything in this, and you can actually go through your textbook for the same. So it will be actually easy. And tomorrow, after I finish both the chapters, I will be actually taking the question papers. So I will be taking the question papers and literally showing you where the sums have actually come. So all your illustrations, whatever we have solved in the textbook, are basically is what is being asked to you in the exam only. So there is nothing that you have to like do. Like again you have to learn something, or again you have to go and see. No. So what will be my sincere request to you is the 2 sessions that we have handled, and this the 3rd session we had a entire thing. So I want all of you to work out all the illustrations again. Okay, please work out all the illustrations again and see whether if you're able to do it within the time. Just take 10 minutes time for this. Keep all stopwatches and then do it. Okay, so it will be first time it will be difficult, because first time after understanding concept without referring to any answers, if you do, it will be a little difficult. Like you will not be able to finish it within 10 minutes. I agree. The next time that you're going to solve and do it, it will definitely come within time. And if you say, so many times we have to do, yes, there is no other goal. You have to do. When you practice only, you will be able to manage the time. So yeah, I have got a few comments telling good, and it was easy, and I'm also happy. Now done. So we go into the next most important yet easy chapter. Okay, so accounting for the bonus issue. So the first part of it we have seen is pre or post incorporation. So this has got something to do with the profits or losses for the period, correct? So when we saw this chapter entirely, I started from the word profit or loss. Now when I go to the next chapter, which is accounting for bonus issue, I'll be handling bonus issue today. So accounting for bonus issue, I am going to concentrate mainly on the balance sheet items, which is the capital part of it. Clear? Still now in pre or post incorporation, I was handling the P&L items of the particular company accounts. That's the profit and loss account. And now completely we are going to see the balance sheet part of it. Okay. So we are entering into chapter number 6, accounting for bonus issue. As far as this chapter is concerned, you have two parts. One is accounting for bonus issue, and then is the rights issue. So in rights issue, when you look at the particular concept of rights issue, I had found 1 to 2 comments telling that, ma'am, there is a little difficulty in understanding that particular concept. So if you go and do like say 2 to 3 examples, rights issue will be the most easiest concept. What you have to do is they'll be giving you it either in 1 mark, or sometimes they might give it to you for 4 marks also. But if you're able to understand the X price and all that, whatever are the related terms, that concept becomes very easy. Coming back to the bonus shares, it is one of the most easiest topic. And here only you have the entries to be passed. And if sometimes the questions are asked, you also have to prepare an extract of the balance sheet. Okay. Sometimes you are, sometimes no, most of the times you are asked to do first the journal entries. If it's going to be for a 4 marks or lesser marks, then you have to just do the journal entries. If it is going to be for a little higher marks, then you are supposed to do even the balance sheet extract. Is that clear? Whenever a question from the bonus shares is given to you, what are you expected to do? The first part of it is the journal entries. So when I say journal entry, so what is a journal entry? So before we can go, what is a journal entry? It is a record, correct? As in when a transaction happens in the business environment, in order to not forget it immediately, you will make an entry in the books. So what is this entry? What is books? So coming back, what is an entry? Based on the accounting principles, the first, as in a first-hand information, if you are recording it with a rule called as so and so account debit to so and so account credit with a narration. So that is called as an entry. What should be debited? What should be credited? You will have the golden rules of accounting. So the golden rules of accounting say this account has to be credited, this account has to be debited. So now how will you do what account it is? Then you have to identify. After reading a particular question, you are supposed to identify the accounts. The accounts can be classified under traditional approach as well as the modern approach. So it will be a little theory class now, okay? So all of you please listen attentively. So there is a classification of all the accounts. So it can be done under the traditional approach or under the modern approach. Under the traditional approach, the accounts are classified as personal, real and nominal. Personal are those which is in the name of a person. Real are those accounts which generally include your assets which you can feel, see, touch, everything. Nominal are those which are related only with the P&L items such as your expenses and income. So when I was talking about the golden rules of accounting, once if you have classified if an account is a nominal, personal or a real account, your golden rules of accounting say this has to be debited and that has to be credited. For example, in case of a real account, the golden rule of accounting is debit what comes in and credit what goes out. So I was telling you real account generally is an asset. So we shall consider an example of purchase of a fixed asset, correct? So in purchasing a fixed asset, by cash, purchase of fixed asset by cash. So the fixed asset is an asset which you can see, feel, touch, everything. Cash is also an asset. So both are real accounts, correct? So what is the golden rule that is involved here? Debit what comes in, credit what goes out. Now what is coming in when you're purchasing an asset? Asset comes in. So debit, asset account debit. So what has to be debited should come on to the top. What has to be credited should come to the bottom. And here cash goes out. So it is asset account debtor to the cash account. So this is one such example. So you have golden rules with regard to nominal as well as personal also. So what technically happens is on the whole, what you have to debit, what you have to credit easily under the modern approach to remember is this. all the assets, if it has to increase, they have to be debited. They generally have a debit balance. If you have to increase an asset, you have to debit it. If you have to decrease an asset, you have to credit it. So that is a general understanding. All liabilities and capital accounts will generally have a credit balance. All liabilities and capital accounts will have a credit balance. If you want to increase them, you have to credit it again. If you want to decrease them, you have to debit it. So this is how the understanding goes. And income and expenses have a debit balance. Income has a credit balance. That is why in the P&L account, you write on the debit side all the expenses, on the credit side all the incomes. So first thing, when I'm talking about a bonus issue, so let us come back. So this is all the very basic things that you've studied during your school and college. And now coming back to this particular example or this particular question, whenever they ask you accounting for bonus shares itself is you have to pass the journal entries. I have seen people like when you pass the journal entries, they're very lazy. You don't even have the particular format. You have to write it in that particular format. Only then you will be given marks. Correct? So journal entry has got a format. First thing, on the heading, it will be in the books of so and so. If it is a company, so and so, since we are talking about company accounts and this chapter also is for a company, I'm going to write in the books of so and so company. And then I'm going to write journal entries. Here for the year as at a date, nothing. If it's going to be an account or a statement or a financial statements, that way only you will have this for the year ended or as at a particular date. But if it is going to be just general passing of journal entries, what is very important is how is the format, that is how do you present it in the exam. Clear? So it will be starting in the books of so and so company, the journal entries, and then journal entries for the year ended also sometimes they will give you and they will write, but generally in the statement. So journal entries in the books of so and so. Then you will be starting it. So there will be columns like this. Generally 4 columns. First will be the date. In journal entry, date will become very, very important. Okay, there are 5 things. So date becomes very, very important. And then you have the particulars. What is particulars? It is nothing but the account names. That's what they are, the particulars. So which has to be debited comes onto the top. And in the second line, from the middle, you will write the word to, which indicates that it has to be credited. And then the account name you will be writing. Clear? And then something called as the ledger folio has to come here. And then debit, which is the rupees, and credit, which is the rupees. So debit amount will come on top, credit amount will come at the bottom. So this is how you will pass a journal entry. And the most important thing is the narration. Why actually they have advocated the concept of having a narration actually? When a person who doesn't know accounts, he wants to understand what does this mean. We know that the debit comes on the first line and the amount comes here, credit comes onto the second line. So he will not understand what is happening in the business. So in order to enable a layman also to understand what is happening in the business, they have told, please write like a story. But don't write a story as such, okay? You just write a 1-line narration. So you say if there is a fixed asset purchase, so you read fixed asset to cash, correct? You, me, we know accounts, so we understand. So somebody else comes and they ask, what is this? I don't understand. So for which you will have to write something called as narration, which starts with the letter being asset purchased for cash. That's all. That was in my example. Clear? Only if you write something like this, you will be given marks for your format. What is this? Only journal entries? No, we'll write as we like, okay, chalega. I don't find any headings. We don't find the narrations that is given. And if there is a date given in the question, date also I don't want to write. So if you do like this, the marks will be deducted. Ultimately, the entries that you pass and all make sense. They all are correct. But presentation is also equally important. So when accounting for bonus issue question is given to you, you are first supposed to understand what are the journal entries you are supposed to do. So first presentation will be the journal entries, followed by, if it is asked for more marks, then they will ask you to prepare an extract of the balance sheet also. In that case, wherever a balance sheet for a company accounts is prepared, you have to give something called as notes. This actually, when I discuss the format for the balance sheet, you will be able to understand. So each of the items that you're going to write, you have to give notes. As I was giving you working notes in the prior chapter, here notes means working notes only. You will write the final answer in the final presentation, but notes to accounts may, you will explain everything. So what it is, share capital. So what does share capital have? Equity, preference, authorizer, issued, paid up, everything you will write. The reserves and surplus, what reserves and surplus you will be having. Clear? So this is how you are going to present a accounting for bonus issue sum. Now we get into the concept. So now when will you have a bonus, or what is bonus, madam? What are the conditions attached for a bonus, or how do you do this? Answering all your questions, so we need to have a little basic understanding of what or how the securities that are issued by a company works. When we talk about bonus shares, or when we talk about bonus issue, it is basically related to shares. So we need to first understand what shares are. Generally, when a company starts, a company is generally incorporated with a view of expanding your business and increasing the ways of raising capital. Where you have a business idea, but the business idea requires a lot of capital to be pulled in, and the resources or all your scale of operations to be done on a larger scale. You prefer the company form of a business. And then you go ahead and then you want to register your company, you prepare a different set of documents. Go. Generally, there can be different sources by which a company can raise capital. What is capital? The money that shall be used in the business in economical terms is termed as a capital. Now, for this capital, there are 2 to 3 ways. Like broadly, if you classify, one is the internal sources, the other one is the external sources. So when you have internal and external basis, internal, where the promoter is internal to the company, okay, where the promoter is internal to the company, or the director, or generally it is the promoter, and he gives in or he funds his own companies, that is an internal source of financing. Now it so happens that the promoter has got only some amount of money, he invests it, but then still he requires a lot of money from outside. Then he goes to the external sources. Okay, so when he goes to the external sources, there are different sources or different options that is available to him. The first option and the most easiest option, but yes, it is a lengthy and tedious process, is the bank loan. A company can go to a bank, show all its documents, all its verification details, and it can ask for a loan based on the security it has got. Now, most basically, the bank, either the interest will be high or the process is very lengthy. So the company cannot wait until then, and it has to raise a little more money than what security it has. So it can ponder over the other options. So one major option that is there is the issue of securities by a company. All along we have seen underwriting commission, debenture interest, and all that. So the securities that can be issued by any company are 3 types. One is the equity shares, the second one is the preference shares, and the third one is the debentures. So you need to understand the share itself is divided into 2, the equity share and the preference share. So what are shares, or what is the share capital? As I told you, capital, money used in the business. So that money you raise and bring into the business in the form of issuing shares, it will be called as share capital. Now the shares can be either an equity share or it can be a preference share. Now, preference share, from the very name of it, you can understand it has got a preference. Preference over whom? Preference over what? So they have a preference over the equity shareholders. When and all, in what cases they will have, madam? When and all, they are given preference. That means preference shareholders are only good shareholders, or that is only beneficial for us. They have a preference. The preference shareholders have a preference over the equity shareholders in 2 things, or at 2 times. When the dividends are being declared, first dividend goes to the preference shareholder. Secondly, only the equity shareholders will be taking whatever amount is remaining. That is first, while paying the dividends. Second, okay, first paying the dividends. Second, while the winding up of the company, I'll have to repay the capital. No, if I am a particular shareholder, for example, ABC company has today issued shares. I have paid money, I have taken their shares. So what has happened? I have given some money, say 100 rupees I have paid, 10 shares I have purchased. Clear? So my 100 rupees is remaining with them. They are now closing the company. So they are supposed to give back my 100 rupees now. If I am a preference shareholder, first they will give me back my amount. And then if anything is remaining with the company, then they will give it back to that. Anything amount is remaining with the company, they will give it to the equity shareholders then. Got the point? So while payment of the dividend, first preference given to the preference shareholders, then only equity shareholders, the remaining preference is given. So they are like residual owners. Whatever is remaining only they will be doing. Then you can ask me, then what is the purpose, madam? I can be a preference shareholder and get preference in everything and go. Yes, you can get. But if you become the equity shareholder, you will be able to vote. Equity shareholder means owners of the company. Correct? If you are an owner of a business today, if you don't have profits, will you take your salary or will you take your share? No, you will think about the business first. Correct? The same logic applies to equity shareholders also. They will first cater to the preference shareholders and finally they will be taking their money. So it depends. A company can give equity shares also. A company can give preference shares also. Based on your interest, if you want to have the ownership rights, you become an equity shareholder. If you say, no, I want some fixed income every month and let me go with the preference shares and then come out after a period of time, go with preference shares. The third type of security is the debentures. Debentures also, there are people like public, they come and they invest in your money or in the debentures. So debenture also is a security. But unlike your shares, debentures are like loans. Instead of bank giving you the loan, people have given you the loan in the form of debentures. So definitely, even if you earn a profit or don't earn a profit, the debenture interest has to be paid. This was the concept I was discussing in the session 1. Charge against the profits, appropriation of the profits. Appropriation means dividend is an appropriation. So in case only if you have profit, you will pay dividend. So that is an appropriation. But when you talk about debentures, since it is in the form of a loan and it is a secured debentures or a secured loan, the debenture holder generally will have to be paid their interest irrespective of whether profit or loss is earned by the company. So that is a charge against the profit. So this part of it, is it clear? So what is a company? A company means large scales of operation can be done and huge amount of capital can be brought in. Now, when I talk about huge amount of capital or money being invested in a company, I told you there is an internal source and an external source by which you can raise and pool money into the company. One internal source is through the promoters. If they are very rich and they can afford to give you money, you take money from them, they put in their own money. If not, the second thing is go for an external source. So generally, how do you go for an external source? You want a home loan today, you go to the bank. Same way, company wants a loan, it goes for the bank. It asks for give me a term loan or you give me a ODCC. But there are constraints attached to it. If it is a new company and it doesn't have any security to be given, generally the other form of raising the capital is by the issue of securities. What are the securities? Securities generally are of two types, shares and debentures. You can have different types also. The most popular are these. Shares are further classified into preference shares and equity shares. Debentures are the secured debt against the company. The debenture holders, I mean the people who subscribe for the debenture, they'll be called as the debenture holders. Shares will be called as the shareholders. The return that the shareholders get is called as dividend. The return the debenture holders get from the company is called as the interest. Now, the very terms as dividend and interest themselves say dividend is paid only if you have something to divide. If you have a profit, only then dividends come. If you have or not have profits also, interest comes into picture. Even if you take a bank loan, it is irrespective of whether you have an interest or not, you are supposed or you end up paying the interest still. So this interest is a charge against the profit, whereas dividend is an appropriation of the profit. Good. Now, shares issued can be preference shares and equity shares. Preference shares have a preference over the equity shares in two things. One is they have a preference in the payment of the dividend. That is, if there is dividend declared, first dividend should be paid to the preference shareholders, only then to the equity shareholders. At the time of winding up of the company, for the repayment of the money, the capital that these people have given, first the preference shareholders will be given back their money, and next it will be the equity shareholders who will be receiving their particular money back. Now, when I talk about shares, in order to protect the investors, because we are the public who is subscribing to it, so generally the public have to be protected. There will be few people who know accounts, who know law, everything like us, but there will be few people from the other backgrounds also who want to like invest their money and make it double. So people who are like, mostly they will be very aware of whatever they're doing, but generally the SEBI, in order to protect the people or the shareholders while doing a particular investment, has prescribed certain rules so that the rules have to be followed to protect the particular investors. So in case of every share, the entirely how much of the total amount you have to raise by a company will be called as the capital. If you issue shares, it will be called as share capital, correct? So the total amount of money that you want to raise will be 1 lot. For example, say my company today wants 1 lakh rupees. To get 1 lakh rupees, it's not possible. Like if I go to a bank, 1 lakh they'll give me, but I don't have security. So what I do, I want to go for issue of shares. So I issue shares and I say 1 share worth 1 lakh. Can I give it like that? Generally, no. It will be like you will have to divide the number of shares. So generally the SEBI rule that says is, or it says is for better pooling. Even any sensible person doesn't do that, okay? If there are 10 to 15 people, the amount that will pool in is more. So he'll break down the entire amount. So the each individual amount, for example, 1 lakh shares are broken down into, or 1 lakh rupees is broken down into 10,000 shares. So 10,000 shares are available with me, and the per share value will be rupees 10. So this will be 10,000 into 10. When I give my or issue my prospectus, or I give a paper advertisement including or giving my prospectus, I will be able to pool in money. A person from Chennai will purchase 500 shares. So how much he has to pay? 500 into 10. A person from Pune will be subscribing for say 20,000 shares. So how much he has to pay? Likewise. So the total amount is broken into number of shares into the value per share. Once you become the shareholder of the company, you will receive a certificate acknowledging that you have become or subscribed to the shares of my company from so and so date, and you become a shareholder. It might be an equity shareholder or it might be a preference shareholder. On the face of the certificate, you will be told how many number of shares that you have subscribed into whatever is the value of the share. So that value of a single unit will be termed as the face value or par value or nominal value. Is that clear? Now, why am I doing all this is there is one clause in the bonus shares before you have to satisfy this. Now, this face value generally, for our understanding, consider it to be rupees 10. Okay. The SEBI has put the second condition, apart from dividing the entire share capital into a different number of shares, the second condition that you people have to meet also is the entire 10 rupees should not be taken in one installment. It has to be split into more than 2 installments. So a minimum of 2 installments have to be there. And apart from that, if you want also, you can have. That is, if you don't want the money urgently, you can have it in the installment. So when you pay or when you want it, you can ask them to give it. Correct? So when initially the person has to subscribe for your shares, it is enough that if he pays the first installment alone. So by default, the first installment is called as allotment. That 10 rupees I'm talking about the face value. The face value or the par value or the nominal value of rupees 10 is not collected in one installment. It has to be collected in different installments. And that different installments have to be a minimum of 2. The first installment by default is called allotment, is called as application money. The second installment is called as allotment. Then there can be calls. So whatever happens after that, they will call. Once after you subscribe for the shares, giving or paying the application money, the company will receive your application money and will see, oh, okay, these people have all subscribed. Good. And how much you will do is you will allot them and you will give them letters. Respected madam, respected sir, so these you have applied for so and so and paid me so much money. I'm very happy to receive the money and hereby you become the shareholder of my company. Please take your certificates. So share certificates will be given to them. Then you say, madam, allotment money to be paid is so much. So to everybody you will be writing a letter on so and so date. So we give you a time of 3 months. Please make sure that you pay your allotment money, which is the second installment. After that is over, then when you need the third installment, you will again write letters to everybody. Dear shareholders, please pay so and so amount, which is the call amount. So that is how an installment basis you will be collecting the value for the company. This is also done 2 ways. First thing, to ensure that the company spends what it wants. That's all. Chumma, if you give 10 rupees at one time itself, what will happen? The company might waste it or not spend it, or it will invest in something which is not necessary. So in order to avoid all this and also to protect the investors from blocking their money at one time, the regulations have come up in such a way that it has to be made in an installment payment. Clear? It has come in such a way that they have to make an installment payment. I think the time is 2:06, right? Okay. Okay, I'll just do a 3-minute concept and I'll wind off the session. So they have to do an installment payment. Now, once after you subscribe to the shares of a company, you will be called as their shareholder. Now comes the concept of the bonus issue. So what is bonus issue? From the very name, bonus means additional, correct? When you're working with or you're working in a company, if they are impressed very much with your performance, every year they'll give you a hike in the salary. Apart from getting so much of the salary, they say you have worked so much and it is very impressive. We are very happy with your work. So please take this additional amount. So technically, bonus is addition. Now, when you talk about bonus issue, it means issue of additional shares. That's all. I am a person. I have already 10 shares in a company. I have subscribed to 10 shares and paid money. So I am a shareholder in a company with 10 shares in my account. It so happens that a company wants to give you bonus shares. So I don't have money with me. I cannot actually purchase something. So it will say, don't worry. Bonus itself means something free of cost. You need not pay for the bonus. I will give it to you at my own cost. Correct? Generally, why will you have shares or why want to issue shares? You want money from shares. And first time when they issued, I gave them money, took 10 shares. Second time, now they are telling, don't give money, but I will give you shares. That means I will give you at my cost, but shares will be registered in your name. So next you might ask, why would a company like to do something like this? Shareholders, okay, you can be very loyal to the shareholders, give them their dividends on time, everything you can do. Why should you give them additional shares? What will happen if they give additional shares? One thing is dividend will increase, correct? The payment of dividend actually does in the number of shares that you will be having. How much is the share capital you're holding into the percentage of the dividend will be your dividend. Technically, if they increase the number of shares, your dividend percentage also will go up. That is, the amount of dividend will go up, correct? And second point is, there will be a lot of shares. If it's going to be an equity shares, they're going to do a bonus issue. What will happen? There will be what? Your voting powers also will increase, correct? But it will remain constant, your voting powers. But then also there will be a dilution. Technically, you cannot say dilution because you are the person who's getting those number of shares. So one thing is the dividends will go up. Why would any company want to give you more and more at that particular cost? Yes, companies will want to give you more and more wherein they are having good amount of reserves, correct? If a company is recording more and more profits, so it will end up in paying the taxes. So what it will do is, let me consider an option like this, and it will want to convert those particular reserves into the capital. So ultimately in its balance sheet, if you're going to look at, it will have reserves. So under the shareholders funds, under the first heading, you will have A, share capital, B, reserves and surplus. That is how it is presented. So now what happens, the amount from the reserves and surplus will go and sit in your share capital. So what is the one benefit out of this? Not like every time they do this to evade, I'm not telling that. But there also what you can do is, in order to show it as a better presentation also, and it is the call of the company wherever it wants to convert the reserves into the capital. So the issue of bonus shares or the bonus issue is also termed as a scrip issue or capitalization of profits or capitalization of the reserves. So bonus issue is given to the existing shareholders. No new shareholders. It's given to the existing shareholders in the proportion of the shares held by them. Okay? At free of cost. And this cost is borne by the company itself. How will it bear? From the profits that the company has already accumulated in the reserves, the bonus shares will be issued. So let's wind up the session with this today, and tomorrow afresh we'll start. I'll give you a briefing for say 20 minutes and explain to you all the conditions with regard to the bonus issue, and we can go ahead and do 3 questions, and the same 3 illustrations are given behind your behind the book also as the practical questions, and we will discuss the rights issue tomorrow. Okay, with that we'll be doing 2 to 3 problems. That's all. Technically a one-word question, rights issue, but you have a lot of theory which actually frightens you when you look into the book, so don't get confused. I'll do it, let's say, tomorrow. Is that clear? So then by tomorrow we will definitely finish chapter number 6, and post this, so probably I was just thinking to do preference shares and debentures, the redemption part of it, but half of it actually was there in the foundation and the CPT while I was handling, so I'm not sure if that is okay with you people. So if it is okay, then I will go to the next important concept like the cash flows that I can do so that this will get over. Probably after that I will sit and do, or I will start thinking about this branch and the department and amalgamation. So amalgamation is personally my favorite, so it is a good thing. It's a nice one actually. So I'll just let you know. But for today, we break up with this. Okay, so we will be doing tomorrow the accounting for bonus issue and the rights issue. Okay, thank you.